Did you know that Donald Trump, Jeff Bezos, Elon Musk, Michael Bloomberg, and George Soros all have something in common? They all legally paid $0 in federal income taxes in recent years while building billion-dollar empires. I'm Christopher Nelson, and after making millions through 3 IPOs and studying wealth management for over a decade, I've discovered that the problem isn't billionaires paying too little. It's that most high earners are paying way too much. Today, I'm going to show you the exact strategies used by Trump, Bezos, Musk, and others that have helped save me hundreds of thousands of dollars in taxes. Now, I have to say, these are strategies for educational purposes. This is not advice. Let's dive into the most misunderstood aspect of wealth building. Here's what's actually happening. While these billionaires use sophisticated legal strategies, most high earners, especially in tech, are stuck paying maximum tax rates. You're making great money, maybe you've had some equity wins, but you're watching 35 to 40% disappear to taxes every single year. Meanwhile, you see headlines about billionaires paying nothing and think that must be illegal, or that's only for people with billions. Both assumptions are wrong. Let me break down what's really happening with 4 specific strategies these billionaires use and why they're completely legal. Strategy 1 is the buy, borrow, die method. This is exactly what Jeff Bezos does. Instead of selling Amazon stock and paying 20% capital gains taxes, he borrows against his stock portfolio at 2 to 4% interest rates. Here's the math. If Bezos needs $100 million for a new venture, selling stock would cost him $20 million in taxes. Instead, he takes a security-backed loan for $100 million and pays maybe $3 million annually in interest, which is often tax deductible, and keeps his Amazon shares growing. The loan proceeds aren't taxable income. And when he dies, his heirs get a stepped up basis, meaning they inherit the assets at current market value, essentially erasing decades of capital gains. It's like the tax obligation disappears entirely. But Christopher, what happens if the market crashes and your assets lose value? Well, that's where strategy number 2 becomes crucial. This is strategic loss harvesting. Elon Musk is the master at this. In 2018, while Tesla stock was rising, Musk strategically realized losses on other investments to offset his Tesla gains. Here's how it works. Let's say he made $50 million on Tesla stock, but lost $60 million on a SpaceX investment. Instead of paying taxes on the $50 million gains, the $60 million loss wipes it out entirely. Plus, he can carry forward the extra $10 million loss to future years. This isn't cheating, it's intelligent portfolio management that the tax code specifically allows. Now you may be thinking, but I don't have volatile space companies to lose money on. That's where the third strategy comes in, and it's Donald Trump's personal favorite. Strategy number 3 is real estate depreciation, and it's incredibly powerful. Real estate allows massive depreciation deductions based on the idea that buildings wear out over time, even when they're actually appreciating. You can buy a $10 million commercial property, and the tax code lets you deduct roughly $300,000 annually for 27.5 years for residential or 39 years for commercial. That's a $300,000 paper loss that you can use to offset other income, even while the property is worth $12 million in generating rental income. Trump has used this to offset income from his other businesses, TV shows, and investments. But here's where it gets really sophisticated. You can actually amplify all of these strategies through the 4th method. This 4th method is debt structuring and interest deductions. Michael Bloomberg and George Soros excel here. They borrow money to make investments, then deduct the interest payments. Here's a simple example. Borrow $10 million at 4% interest to buy an income-producing asset yielding 8%. You pay $400,000 in interest, tax deductible. Earn $800,000 in return, and the net $400,000 gain might qualify for preferential capital gains treatment. Plus, if structured through the right entities, even more expenses become deductible. Management fees, professional services, and even some travel costs for investment purposes. Now, I know what you're thinking. Christopher, this sounds great for billionaires, but what about somebody like me with a few $1,000,000? Here's the surprising truth. You don't need billions to use these strategies. You just need the right structure and the right approach. Let's look at each of these again, but aligned to the investor with $1 to $30 million in net worth. First, let's unpack the buy, borrow, die strategy. If you have a $3 million portfolio with significant unrealized gains, you can take a securities-backed line of credit for $1 million at 3 to 4% interest. Since the loan proceeds aren't considered taxable income, you can use the funds for living expenses or new investments without triggering a tax event. When you pass away, your heirs receive the assets with a stepped up basis to current market value, which can eliminate the capital gains tax that would have been owed on the appreciation. Now, there's some important nuance here. The interest on these loans is generally only tax deductible if you use the loan proceeds for investment purposes, not personal living expenses. And yes, a significant market drop could trigger a margin call, forcing you to sell assets. But with the proper loan to value ratios, this risk is manageable. Next up is smart tax loss harvesting. With concentrated stock positions, you can sell shares at a loss to offset capital gains and up to $3,000 in ordinary income each year. Then repurchase a similar but not identical security, like an ETF, to maintain your market exposure. This lets you manage both your portfolio and tax liability proactively. The key here is avoiding the wash sale rule, which prohibits claiming a loss if you buy a substantially identical security within 30 days. While an ETF is often a suitable substitute for an individual stock, you need to ensure it's not considered substantially identical. This is where having a tax professional becomes invaluable. And to take advantage of real estate depreciation, you don't need Trump's empire. A $500,000 rental property can generate $15,000 in annual depreciation. Scale that across multiple properties or through real estate investment partnerships for massive tax savings. Here's what most people don't realize. This strategy defers taxes rather than eliminating them permanently. So when you sell the property, the IRS will recapture that depreciation and tax it up to 25%. But, and this is crucial, strategies like 1031 exchanges or 721 exchanges let you defer this tax liability indefinitely by rolling it into new properties. And lastly, entity structuring. Set up the correct entity structure for your situation, and suddenly you can deduct management expenses, professional fees, and even some family office costs. This can be very simple, just like this example, or elaborate and complex. The critical requirement: all deductions must be legitimate business expenses with proper documentation and clear business purpose. Personal costs can't be deducted through the entity, but the line between personal and business gets very interesting when you're managing significant wealth. Now, let me give you a concrete example from one of my clients. Let's call him Alex, a tech executive, $5 million net worth, mostly in company stock. He was receiving a lot of equity compensation annually and paying around $400,000 in taxes. So here's what we implemented: systematic stock diversification using tax loss harvesting. He saved $50,000 year one. Securities-backed credit line. Instead of selling stock for a house down payment, he avoided $80,000 in capital gains. Real estate investment through depreciation heavy properties gave him $30,000 annual tax shelter. And then his entity structure for investment management gave him $15,000 in deductible expenses. So his total first-year tax savings in aggregate was $175,000. And this scales every year as his wealth grows and he implements more strategies. If you want to implement these strategies, here's your 3-step framework. Step 1, audit your current tax efficiency. Look at your last 3 years of tax returns and calculate your most effective tax rate. Most tax professionals are paying 35% or more and can get this down to 15 to 20% with proper planning. How much are you paying relative to your net worth growth? Most people are shocked when they do this calculation. You might discover that you're overpaying by 6 figures annually. Step 2, build the right structures. You'll need these 3 key relationships: a securities-backed line of credit with a major brokerage, proper entity structures like LLCs or family partnerships, and most importantly, relationships with certified tax planners and attorneys who understand these strategies. This isn't DIY territory, but it's not as complex as most people think when you have the right team. Step 3, implement systematically. Start with tax loss harvesting if you have concentrated stock positions. This can save you 20 to 50K in year 1 alone. Then layer in entity structuring for expense deductions. Finally, add real estate depreciation or securities-backed lending as your portfolio grows. The key is having a coordinated plan, not just random tactics. Now, I know what some of you are thinking, but isn't this unethical? Look, there's a fundamental difference between tax avoidance and tax evasion. Everything that I've described is legal and encouraged by the tax code. The government created these incentives to drive investment and economic growth. The real question is, do you want to be smart about this, or do you want to overpay out of misplaced guilt? Here's the thing, these strategies work, but they require proper implementation and ongoing management. You can't just set them up and forget them. That's exactly why I created the Wealth Ops Framework. It's a systematic approach to managing wealth like a business, incorporating all of these tax strategies into a comprehensive plan. If you have $1 to $30 million in net worth and want to start managing your wealth like these billionaires legally and systematically, head to wealthops.io or click the link below this video. I will show you exactly how to architect, build, and run your own microfamily office using these same principles. If you want to know more about a microfamily office, be sure to check out this video. I think you'll get a ton of value from it.